Welcome back to the Gray Report. I'm your host, Spencer Gray, President and CEO of Gray Capital, host of the Gray Report, joined once again by Director of Communications and Marketing here at Gray Capital, Dr. Matt Bosnagel, producer of the Gray Report. Matt, there's a lot of news over the weekend. Again, some of it maybe not directly related to commercial real estate, but some of it really directly is. Talking about the big beautiful bill that was finally passed. Went through a lot of iterations after getting passed in the House, the Senate, reconciliation, and just like clockwork, almost by design, renewed discussions ramped up discussions about tariffs. It seems
Stirring
like
the pot, keeping it
as
spicy.
soon as we have a little sense of clarity and certainty, this uncertainty comes right back to us and hits us square in the face. We're going to talk about tariffs here in a minute, but first we want to talk a little bit about some of the implications of the big, beautiful bill. And I think there's a lot of real estate investors out there that have mixed feelings.
Yeah, I think that those mixed feelings are appropriate.
Yeah.
I also think that this TREP article that was written in July 2nd, so it was before it passed, but after everything material was in place in the bill. But I think that it does a good job of identifying like the real major parts of it.
They wanted to get a good analysis before they left.
Yeah.
For July 4th.
Oh yeah, that's good. That's good. The Senate was hard. The House was hard at work, but TREP had clocked out at them at that point.
Yeah.
So basically, and you noted this at the top, the bonus depreciation is one big thing. They also made some changes to permanently kind of expand LIHTC, low-income housing tax credit. It was there was a tax credit of 4 or 9%, depending on what the time frame was. But now it's expanded to 9%. And
Well, it increases the allocation of the 9% LIHTC credits.
Yeah.
Which is more affordable housing. I mean, what that means is more money for housing development in the United States.
Yeah, and I think that's great. I think that there are some things that are, I don't have a problem either with opportunity zones getting expanded. I think that there's another one, this Section 899, which barred foreign investment. They cut that out of the Senate bill, so that's going to be, more foreign investors can invest in, which is probably, good news for CRE investor, the CRE market that is, looking for something. Maybe sometimes the investors are going to come out from outside, and so that barrier is not in place. But the upshot for all of this is deficits, I think.
I think that's the risk, and because the deficit side related to where the long end and the yield curve, where bonds interest rates are going to go, because of the perceived risk of larger U.S. deficit, rising debt. Can the U.S. support it? What's the interest going to be on U.S. debt and bonds?
Yeah.
That, I think, is yet to be seen. I think, there's different ways of forecasting and modeling. The CBO has had different levels, different estimates. And then when you bring in this factor of tariffs and tariff revenue, that also throws a wrench in the gears, because you either could say, oh, well, look, we're actually getting all this tariff revenue. You could also say, well, how long are the tariffs are going to be enacted and at what rates? Before we get into all that, Matt, I feel like we glossed over 100% bonus depreciation.
Yeah.
Is that's a big deal. And if you've been investing in multifamily over the last 3, 4, 5, 10, 15 years, you understand it's huge. It's not just real estate. It's not just multifamily. It's all types of investment. It's for factories, but for a real estate investor, it's incredibly attractive, because you can receive a huge percentage of like the investment that you make. So what it means is like an LP investor, just a regular, normal, passive investor. You invest into like a syndication, for example.
Yeah.
We're going to be able to get back a significant amount of what you invested back as a paper loss on your K1 in that year, because you're allowed to take instead of taking a depreciation schedule, over 30 years, depending on what the product, whatever the component is, there's different depreciation schedules.
Little tax breaks over 30 years.
Yeah, over time you can accelerate all of those deductions in the first year. And so what you'll typically see on your first year one tax return, especially if you do like a cost segregation study and analysis, is that you have this massive loss in year one, because it's basically taking all of those components are going to depreciate over that scheduled period of time. You're taking that full loss, which allows you to offset yield and income over the next several years. So that allows a real estate investor to essentially shelter all of the income and distributions that they receive from that property. So a real life example, you could receive $100,000, $1 million of distributions, but the IRS sees that you lost money, that you have a negative, that you have a negative amount of income for your K-1.
And before, they were trying to phase this out, or at least dial it
It was
down.
it was in the process of being phased out. So this first went into effect in 2017 at the Jobs and the Tax and Jobs Act that was passed in the first administration, and that led to a ton of investment in multifamily housing. There was a little bit of cap rate compression, but it allowed for it to be so much more investment in terms of in terms of a tax shelter.
Wait,
And-
so in 2017 they allowed for bonus depreciation?
Yeah, they allowed 100%.
Okay.
It went to 100% in
went to 100%.
2017.
Okay.
And then a couple of years ago it started to phase out. It was 100, then it was 80, and then it was 60. It was go down to 40.
Yep.
And so
We
in the
talked
last,
about
like, if you're a multifamily investor, you've noticed over the last couple of years on a new acquisition, the amount of losses were much less than they were in previous years, which means you had fewer losses to shelter gains. And so not only can you, if you're a real estate professional, again, none of this is tax advice, talk to your CPA, but what you can do, you can take the losses from one property and apply those losses to the gains of another property. So as long as, if you're selling a property, it's
Yeah.
kind of like some people call it the lazy 1031 exchange. And it's
Okay.
because at 1031 exchange, there's a lot of rules, there's a timeline, a lot of rules actually. But just by using depreciation, as long as you acquire a property in the same tax year as you sell it, or you can acquire the property years later because the losses carry forward. But as long as you acquire that property to generate the losses, depending on what the investment is, you can shelter a significant amount of the gains from the property you are then selling.
Okay.
And so let's say, for example, you buy a bunch of properties and then you just sell one. There's a good chance you might be able to shelter all of the gain that you earn from that property. Now, there is depreciation recapture. So at the end of the day, if you don't have losses, what the depreciation that you did not actually use does get taxed, but it's at a lower rate than your regular income tax. So it's a much more tax efficient.
Yep.
And again, depending on how you're rolling and buying properties, you can defer those tax payments for quite a long time.
Yeah.
Done this myself, done this for most of my family, done this for our investors. Again, I'm not a CPA. I can't give any tax advice. Talk to your tax
But these are
professional.
things that are possible.
But it makes multifamily that much more attractive, and the reduction in bonus depreciation being able to take has directly coincided with the market weakening. So it's like another blow. Rents are low. It's the interest rates are high. Oh, and by the way, you're getting less depreciation and less
and
losses.
I remember there was some discussion of it being an incentive for people to invest before the end of the year, before it
exactly.
gets phased out. And
There
things
are a
like
lot
that.
of not the majority, but there are a lot of investors that we talk to that only invest for the losses.
Yeah.
Like, I don't care about the returns that much. I don't want to lose money, but I'm making so much money.
Yeah.
I just need the losses. I'm making money over here. I'm a qualified real estate professional. I need to generate more losses.
Yeah.
So, again, without 100% bonus depreciation, it's harder to do that. You might go other areas, like oil and gas has a lot of tax advantages as well. There's a lot of depreciation. There's other things. You can build a factory and you can depreciate it. You can buy a boat to depreciate it. There's all kinds of different things you can depreciate, but real estate is one of those things.
Yeah, it's interesting that I mean, it's not interesting. It makes sense. It coincides with Trump's, first term. He put that 100% in, and now he's phasing out.
And then now
attempts to
they're
dial
making
back.
it permanent.
Yeah.
They're making it permanent, which is huge. Before it's sunset,
Oh, okay.
the other piece is opportunity zones. They're also making the opportunity zones
Yep.
permanent. Now they are redoing some of the census tracts, I think, for the opportunity zones, which is a really good thing because when they made the opportunity zones, also part of the first, 2017 Tax and Jobs Act. Some of the census tracts they chose made sense. Some of them were just like all of downtown.
Yeah.
And like all of downtown Indianapolis, the mile square is just like a QOZ, an opportunity zone. So I think there could be a little bit more nuance and probably like a better process to choose, or just like make it more like project enabled instead of
Yeah.
area. But
I agree.
it's a way to defer taxes. They can be can be some hoops you have to jump into in through, like how long you have to hold the property to fully utilize all of the benefits. I think everyone is fully utilizing the benefits because you really have to own the property for longer than 10 years to get the full reduction. But if
Opportunity zones, though, these are talking about you get kind of tax breaks or subsidies for building in there.
tax breaks,
Okay.
so you have the ability to completely reduce your capital gains liability.
Okay.
Completely down like to zero if you own the property for a long enough period of time.
Okay.
I want to say it's 14 years. It's longer than 10.
But we don't talk about that.
We're not opportunity zone experts.
I know.
I'll just tell a story when I was asked to be on a panel about opportunity zones, but the other qualification, the limiting factor for like a group like us that acquires properties, you have to make a significant investment. So typically, like an acquisition doesn't qualify for an opportunity zone.
Okay.
It's typically or almost always. And someone please correct me because again, I haven't taken a deep dive recently, but it's pretty much only applied for new construction.
Okay. That was why I remember discussing this way back when, and it was something he's like, well, it doesn't necessarily apply to the stuff that we're doing at Gray Capital.
Yeah.
But it does. I like the idea. I think it's interesting. And what I got from it was a little inflexible. Like they're not everywhere either, and sometimes they're in places where it makes more sense than others. So
You want to know who helped come up with opportunity zones?
Oh yeah.
Sean Parker from Napster.
Oh wow, that's great. Good for him. Really bounced back.
Yeah, right. Was it Tim Tillis? I think he got in touch with the senator from South Carolina. I think.
The North Carolina, yeah.
Yeah, North
Tom
Carolina.
Tillis,
Yeah.
That's funny. Well, thanks, Napster. And thanks again, Napster.
The more you know, Matt.
Yeah.
But all the exciting stuff for multifamily, and there's some other positive things I think from just a tax cut perspective.
Yeah.
Obviously, not seeing a tax increase on a lot of folks. A lot of focus has been paid to wealthy Americans that aren't going to get taxes raised. But there are a ton of deductions for just like everybody also. I mean, the huge increase to the child tax credit, no tax on tip, no tax on overtime. Obviously, then there's a lot of cuts to some social services. That's controversial. You could make the argument that maybe some of that needs to happen. Neither here nor there, but that's controversial. And then there's also a lot of spending that I think is pretty controversial also because the whole idea is, we're trying to reduce, deficits over here and budgets. And that was kind of the idea of the Trump administration and DOGE. But we're spending all this money on, a lot of it's like on border security and enhancing the military. And that sounds nice, but man, it's spending a lot of money.
Yeah.
And so can we really afford to do all of that? I think there's a lot of people that would have preferred that we just did the tax piece and cut some and didn't do all the spending.
Yeah.
But
I
can't solve all the world's problems with one bill, I guess.
Yeah, well, and I think that the cuts to Medicare and Medicaid is kind of a can of worms. I won't have time to or won't be able to discuss right now. However, I think that the spending and where it is on the balance sheet is also very relevant. That's what they kind of close on in this TREP article. It basically saying like here the quote is the risk here is that the expanded deficit puts upward pressure on interest rates due to, one, the government's need to issue debt to finance the deficit, and two, the Fed's need to stabilize inflation. As a result, we're likely to see the long end of the yield curve drift upwards, means a higher cost of capital, maybe higher forever, not higher for longer. And they're also saying, and this may be, I don't know if this is in the article or not, but it's true. I don't think that the real estate market, commercial real estate market, has truly adjusted to higher rates in their pricing. So there's still maybe some more rebalancing they could have. Maybe it means slower price growth. Maybe it means falling prices for some assets in some markets. Depending on the supply demand dynamics. But it's not great news because you're coming at it from both sides. There's that inflation risk and the borrowing debt kind of the government. And I would say, and I don't know if this is included in the two things that is listed in the TREP thing, but also that dynamic between the 10-year Treasury and this like risk-free rate is it suddenly going to become a risk-on rate or like a more risky rate, which means that it's higher, it's less. Yeah. So there's a little bit. That's the uncertainty. I would say.
I don't. And so what are the arguments for the bill causing inflation? I guess outside of just interest rates would be higher. That would reduce. It would be
Yeah, I think that they are saying. Well, no, they did say they said that deficits do increase inflation in general because it's just more spending in increases
more spend.
inflation.
Yeah, more spend. Yeah, the more spending that the government does makes sense.